So we obviously have too much to cover in 45 minutes in the depth that we'd like. So let me just take 60 seconds and then turn it over to Keith. So the markets bottomed in March of '09. Since then, equities have increased 2.5 times. Yep. Interest rates are still, even though the Fed has raised rates, the cost of money with the 10-year Treasury at a little over 2%, I think about 2.2. Inflation running around 2%. You still have the cost of money essentially at zero. The economy's been growing at sort of 2%. Goes below it, goes above it. It's certainly not 3%. When I was growing up, I was always told you better have GDP growing at 3% in order to have job growth. Well, yep. We've had job growth. A lot of people debate about the level of 4.3% because they say that doesn't account for, number one, underemployment, and number two, of course, doesn't count people that are not looking for jobs. But overall, I think for what happened in '08, you'd have to say to yourself, not bad. Right. So how many people here are invested in equities? Just raise your hand. Okay. Are you happy with the results? Okay. A lot less. This is what's really unusual, right? Yeah. We've had frankly, a really unbelievable market for 8 years, and it doesn't feel as good as it should.
It's probably one of the most hapless. Who's feeling euphoric here in the audience? All right, we got one.
John, but John's always
That's
euphoric.
Because of art. That has nothing to do with the market. But you know, when you think about prior bull markets, and Dr. Greenspan coined the phrase irrational exuberance, I think we have seen throughout this bull market, we would kind of flip that around and say we've almost experienced irrational pessimism. It literally has been so we're in the 9th year, we just entered the 9th year of the economic expansion, the 9th year of a bull market. You know, people who have been invested in equities have made a lot of money, and I've never seen such a boring party in my life. People have just not had fun with this. And so it's been an interesting dynamic, and one very unusual, because at this stage normally, people would be going crazy, just like the late 90s, right? When everyone was invested, you know, and valuations became absolutely crazy, and you set the stage for, obviously, the downturn, which came in a big way. But it's been, so this cycle has been different for a lot of reasons, and Bill touched on one of them. You know, and that's the fact that as we enter the 9th year of an economic expansion, we're still only seeing growth with a central tendency around 2%. And a lot of people are trying to figure out why is it we are not seeing faster growth. And Bill and I spent a lot of time comparing notes on this. But you know, if you take it back to the basics, you know, real GDP growth is a function of the sum of growth in the labor force and growth in productivity. That's how you get, that's mathematically how you get GDP. And so if you break each one down, you know, both over this period of time, over the last 8+ years, both productivity and population growth, or labor force growth, have been both less than 1%. And that's why mathematically GDP has been what it is. So if you say to yourself, how do you get out of this secular stagnation box? And oh, by the way, there's been only one other period where we've seen such an extended period of secular stagnation, and that was the late 70s, the Carter period, plus the early 80s, the recession. And then when Reagan came in and started to do a lot in the fiscal side, you broke out of it and productivity came up. So it's somewhat unprecedented. But I don't think any of us expect labor force growth. You know, the only way you'd see that is if you saw a significant increase in immigration. Don't think we're going to see that. So it comes down to this one lever to pull to change the dynamic of secular stagnation, and that's productivity. And the other thing that's been missing from, there's been a number of things missing from this expansion relative to other expansions. And one of the other things that's been missing is the lack of investment by companies, also known as capital expenditures. You know, CEOs have not had the mindset, the confidence, the optimism to put their capital to work. So companies right now have about $2.5 trillion of cash, about half here, about half overseas. And the most direct correlation between productivity, growth and productivity, is growth in capital investment, because it gives workers more capital per capita, and that allows people to become more productive. So unless we see that, and unless we ultimately see some additional fiscal spending, because typically in a cycle, you start with monetary policy, right? The Fed makes things, it infuses liquidity into the system. It dramatically reduces rates. We saw that. Consider that the jab in the fight. And then the right cross normally is then fiscal policy comes barreling in, and away we go. And we haven't seen the fiscal either. So it's been a very unique cycle, Bill. And that's, again, unless we can crack the code on those things, we're kind of doomed for a continuation of 2%-ish growth, probably for the rest of this cycle, which we think could run another couple or 3 years.
So Keith and I have done this a number of times, and the conversation for the past 5 or 6 years has sort of been the same. Is slow growth, no capital investment. It doesn't feel that good,
right. And
yet when you look at the numbers, so here we are. How high is high? The S&P up 8-odd% this year. Admittedly, and this is something that I personally don't focus on as much as I should, almost half of that comes from less than 10 companies, the Amazons, the Googles of the world. And so we are here, S&P, pretty high. Are we at real risk of a correction here? You're starting to read today's journal, people putting on hedges, talk about black swan events. The only problem with a black swan event is you can only talk about them after they happen.
Right.
And we had a couple of years ago, everybody, let's prepare for the unexpected, and really hard to do.
Yeah.
So are we at real risk of a correction in our markets?
Look, we could always have, as we speak, we could go into a correction, right? But I always take some comfort, I always have the reverse psychology. I worry when people are talking about the tree growing to the sky, right? Versus people putting on hedges. Here we go again, right? People putting on hedges. What's the black swan? People worrying about the correction. Rarely when you hear that, it doesn't mean it can't happen, but rarely when you hear that rhetoric, do you then get the correction, right? So what we would say is, look, if you look at the stock market, and let's use the S&P 500 as the proxy, we had said that we thought the equilibrium level for the market, based upon the earnings that we're forecasting this year for the S&P 500, was around 2450. That's way too precise, by the way, but that's the number. So we're at 2340 something. So you kind of go, well, are we there then? So, and the reason why we had said that is because we had put a certain multiple, 18.5 times, on a certain, again, it's all math, right? But what I'll tell you is you've got to look at equities versus the alternatives. So people get nervous about PE multiples. On a trailing basis, PE multiples are 22 or 23 times, pretty high. On a forward-looking basis, it's about 18.6 times, about fairly valued.
Not so bad, not that bad.
Not so bad. And then people, if they really want to wind themselves up, they talk about the Shiller PE index, which right now is around 29, which is a very high number. For those that aren't familiar, the Shiller, the difference between the Shiller PE and the traditional PE is Shiller goes back and takes the last 10 years of earnings and then smooths them with some kind of inflation indexing, and then puts the price over that, and there you go, and that's 29. But what you got to remember is in 2008, 2009, because of the Great Recession, earnings for the S&P went down to, think about this, 54 in 2008, and I think $55 in 2009. Just by contrast, this year it's going to be $132. So I would argue that when 20% of the earnings stream is so, is a 3 standard deviation level, we're not sure how much weight to put on that. So, we think, bottom line, Bill, we think we can go higher. If you look at the PE multiple, yeah, it's pretty fully valued. But, number one, if you look at the inverse, because this gets into so what are your alternatives? The inverse of the PE is known as the earnings yield, and it's simply earnings over price. and it gives you that ratio gives you it's kind of what yield are you getting on the, per dollar of price on earnings. So right now, that's 5.6%. And typically, people compare that to, okay, so what's the alternative to equities? Fixed income. Sure. To your point before, 10-year bond, 2.1%. 5.6, 2.1, even factoring in, it's a riskier asset, still a pretty good premium. Relative to the investment-grade bond, 3.2%, still a pretty good premium. Relative to cash, 1%. And so on a relative basis, because people aren't going to put their money under a mattress, it's going to go somewhere, you can make the argument that relatively speaking, even though PE multiples are relatively full, that we could see more growth. And so even if you assume that PE multiples stay flat here, they don't expand anymore, then you can argue the market should go up by the growth in earnings. And we're having a great earnings season this year. Earnings in the first quarter are up 13%. They'll be up 9% in the second quarter. And we think next year you could see probably a 5-6% growth in earnings again. So we think there's still some upside here.
So when we talk about the drivers, as you were talking about,
yep.
So a monetary policy, the Fed has said, all right, we happen to own $4.5 trillion worth of securities. Not only are we no longer going to be buying them, which they haven't for a while, we're actually going to let them roll off. I think the current plan is as they mature, not to renew.
Right.
More recently, they're talking about something slightly more aggressive. Okay. On balance, that should be an upward pressure on rates, right?
Yeah.
And then on the fiscal side, the federal government actually has not been a stimulant here at all.
Right.
Sequestration is a word we don't use as much anymore, but in fact, it has been a drag on spending. And so you have the economy. I would make a case that given we don't have stimulation going on,
yep.
maybe 2% isn't that bad. And so we can live with 2% because we have with 8 or 9 years, and everybody in this room has benefited quite well. Let's go over a couple of oceans.
Sure.
And talk about what's going on around the world in terms of the economy. I was in Japan last month, and one of my takeaways is that there was quite a talk about in the last 18 months how the Japanese economy is really showing some signs of life.
Finally.
So you guys travel all over. Your footprint is all over the world. How do you see it?
We agree. I mean, one of the dynamics going on right now, and don't underestimate the power of this, because the other interesting thing in this cycle, if you think about it, at any given point, you had the U.S. has been kind of the engine, coming out of the Great Recession. Europe, it was mired. Japan's been mired. The emerging markets collapsed because they were riding the growth of China. China went from a 10% growth rate to a 6% growth rate. And at some point in time, as you looked around the globe, which you really need to do, there was not one point in which every economy was firing on the same cylinders. And so one was carrying the other, usually the U.S. But we're at a point now, and it began last year, where we are in now a synchronous expansion. The U.S. is still going to grow this year about 2.3. We got Europe surprising to the upside. They're going to grow probably 1.5 to 2. To your point about Japan, they're finally starting to see growth, so assume 1.5 to 2. The emerging markets are now leading the parade because they're the tail of the whip. So they really benefit the most from global growth. And with China maintaining growth in the 6.3-ish%, we can debate whether it's a real number or not, but it's the number. So right now, every economy is growing in a synchronous fashion. That's one of the things so synchronized growth in the global economy is leading to a earnings surge globally. Now, we would say is even though we still like equities more than fixed income, we're still overweight equities. And again, it all comes down to risk tolerance, but generically speaking. But we would say we're still overweight the U.S., but we actually think the developed international markets, Europe, Japan, will outperform the U.S. because they're earlier in the cycle, both the economic cycle and the market cycle. And quite frankly, valuations are more attractive because of that.
Right.
And we are overweight emerging markets because, once again, they're going to be the most leveraged to the global growth dynamic that we're seeing. So we're overweight equities in general. with a focus on international developed emerging markets while still maintaining an overweight in the U.S.
And so all of this is going on, and of course we have political turmoil, depending on how you want to define that, pretty much all over the world.
Yeah.
And one of the curious questions, of course, is that we seem to be, in terms of our discussion of the markets and the functioning of the markets, sort of ignoring all of that. And yet, throughout our history, stuff's always going on around the world. So
Yeah.
it's always a matter of degree of how serious it is. How much of a factor do you, when you are traveling, do you try to put into the outlook here?
Well, you know, what you got to remember is with the market's very clinical. We're more emotional, but the market somehow, the market's the collective emotions of all of us, but somehow in aggregate, it figures out how to sort it through. Because I've gotten, in a similar vein, I've gotten a lot of questions from our clients. We've had these horrific, you know, geopolitical events, right, in London, in Paris, with, you know, and with human tragedy, right? And yet the market, you know, volatility hasn't gone up, the markets haven't gone down. Like, how is that possible? And what the markets do, whether it's an election, whether it's, you know, unfortunately the geopolitical reality we're living with, is it's very clinical. And the question that gets asked by the market is, will that event, will that election have a fundamental impact that will then matter to the markets? Fundamental impact meaning, will it slow economic growth either in that particular region or globally? Right. Will it result in people thinking differently about risk, hence the PE multiple can contract, and ultimately does it back its way up into earnings? And if the answer to all that stuff, as horrific as some of these things are, by definition, is no, no, and no, the market keeps doing its thing. And so, you know, look, it kind of pauses. So when they had the election in France, because that could have gone in a very interesting way, it didn't. You got Ms. Merkel, who's going to be coming up. I mean, God help Europe if they lose her. Right. She's probably been the strongest global leader we've had. And then you've got now, unfortunately, you know, Theresa May made a bet, and the bet didn't pay off. And we still have Brexit coming down the road. So the way we think about it is we have all these things on our radar. We keep bringing it back ourselves to what are the possible outcomes, and then you can do a probabilistic, so here's what it will mean based upon the different ways it can go, and you can still move forward. Because think about it, if all the things that have gone on, and think of all the things that have gone on over the last 8 years, and if any of them had caused you to pull out of the market or not go into the market, think about how much money the opportunity cost of money that would not have been made. So we always say you need to be cognizant of the risk. You need to be a way to build that into your forecasts and your risk assessment, but you can't be paralyzed by the risk, because then you're on the sideline for times that you don't want to be.
So you're touching on something I'd like you to talk about a little bit more. And so, you know, your client base, high net worth individuals, mm-hmm. Okay, family offices. Given what do they talk about? What are they concerned about? Because everybody's been in the market. You know, we have politically here a divided country. I mean, for real. When they sit down and they close the door, yeah. What are they saying?
Well, you know, with respect to the markets, they continue to worry, aren't we at the end? Isn't it over? Shouldn't we be taking money out of the market? And we've had this conversation.
They've probably been saying that for 7 years.
We've been having this conversation for 5 years running, yeah, right? Right. And there will come a time, and maybe it's going to be this year, when that will be a better answer. Now, again, we're never out of the markets for our clients. We don't go, so what will that, if we got negative, again, we're not perma-bulls. We don't have any incentive to be bullish. I mean, we've got a great team of in-house economists and strategists who and we have the ability in our position that we can also leverage Bank of America Merrill Lynch's research, which has been voted #1 for the last 7 years globally. And because we work with a lot of the asset managers, you know, we bring in a lot of their product and use that sometimes to help build portfolios for our clients. We get to pick the brains of the best so we get a lot of input, you know, and then ultimately we decide what we think it is. But, you know, it's, yeah, I mean, it's the same hand wringing. But so if we get to that point, we will go underweight equities, we'll go overweight fixed income. One of the things that we have been saying is that we do think it's smart to be very diversified right now. And diversified means, number one, less correlated assets. That's a fancy way of saying find an asset class that's not going to move in lockstep with the equity market. So if the market does go down, that asset class will kind of do its own thing based upon its own fundamentals. You know, we're getting a lot of interest, and Dennis Moon is here from our specialty asset management group. You know, we invest in timberland, farmland, oil and gas, the physical asset. Our clients love that because, number one, wealthy individuals and families tend to like tangible assets. They like stuff. They like real estate. They like art. They like, you know, so that's a great diversifier. We probably have one of the biggest backlogs we've had in a long time with respect to client demand there. You know, we try to move into, you know, where it makes sense, either private equity or hedge funds. So we're the first to say, and the way we're implementing is we're very diversified, yet we're making some bets where we think we should be. But we're quick to say at some point, if the fundamentals change and we need to go another way, we'll go another way.
So, you know, one of the other questions is they have something called, most of you probably familiar with the VIK, V-I-K, and it's the volatility index, which until the past couple of weeks has really been quite low.
Yeah.
Matter of fact, as low as it's been in quite a while. And as you think about if the volatility index is quite low, how do you square that with anxiety?
Yeah.
And the answer is I'm not sure how you do that.
Yeah. What's interesting is I think there's a couple of things that work there. So number one, if you kind of look back in time, low volatility is consistent with low rates. I mean, back to your point, we have basically a 1% risk-free rate. Number two, you know, you've got a situation right now, and it's also consistent with a risk-on bull market mindset, meaning despite the angst, net, people do think the market's going higher. And the third thing, which is really interesting and different this time, is you've got just billions, if not trillions of dollars of assets that are managed in a quantitative fashion that are just programmed. So when vol starts to hit, when markets do come down for whatever reason, this money comes flying in and buys it. Because, you know, buying volatility has been a very successful strategy.
That's right.
And the other thing too, Bill, is you've got, you know, if you look around the world, there are still literally billions, if not trillions of dollars of assets earning close to zero. You've got sovereign wealth funds out there. You've got pension funds out there. And they all have, you know, they have much longer timetables. So they're coming in and not only buying equities, but they're also buying long-term bonds or long-term treasuries because, again, they've got long-term liabilities they've got to offset. So there's all these dynamics that are kind of going around. And so when we step back and look at it, we don't think it's an alarming thing that we should be going, oh, my God, there's a you know, a flashing light here that we need to be worried about.
So domestically, when we talk about the drivers of growth and what's going on, you have the automobile sector, vehicle sales, which are pretty much at historic highs at a little over 17 million vehicles. Yep. But that market has topped out. So no growth coming from there. We talked about oil. You know, oil prices are once again gone down.
Yeah, and probably stuck in a range of 40 to 60, call it.
Something like that. You're not going to get a lot of growth out of that. Housing sector has been okay, coming on a little bit.
Yeah.
So tending to reinforce the view that going to be hard to get much growth. But yet on the other hand, doesn't seem to be a lot of red flags in terms of a real recession on the horizon, economic recession.
Yeah, so when we step back, because some people say, how do you even get to 2.3%, since that's our forecast? You know, so let's kind of go through the math again, right?
Right.
So consumer is more than 2/3. Consumer is in great shape, right? Unemployment, record low level, not record low, but very low levels. Jobs being created, wages are going up. They've got a very strong balance sheet. Most of them own homes, their biggest asset. And home values have gone up, depending where you live, pretty nicely. So consumer, we think, is in good shape, will continue to spend probably about a 3% clip. You've got, to your point, autos have peaked. We think they can stay in the 16 to 18 million unit range, which means they're not going to be a detractor of growth. Right. On the margin, they won't be a driver. But, you know, with an average age fleet of 11 and a half years and again, a consumer with a good balance sheet, they're going to buy stuff, or they're going to buy enough to sustain it. housing is interesting because housing typically leads a recovery. It's the early cycle. When you see housing start to go, you know the cycle's turning. Well, housing has only recovered 39% of what it lost during the Great Recession. And there's a reason why housing didn't lead it, because it was at the epicenter of the Great Recession, right? It was the catalyst because of over-ownership. Home ownership is down to 63.6%. It peaked at 67. And so what's interesting is, even though we're going into the 9th year of the expansion, you know, housing has just shown up at the party. They got the invitation late, so they're just coming in going, hey, let's go, right? And then the other thing is capital spending, like we said. In the 9th year, we have seen basically flatline capital spending. If capital spending starts to come up, so what's interesting is, even though you're in year 9, just entered it, there's a lot of very powerful catalysts that could potentially, if they continue to, housing, CapEx, still a strong consumer. And by the way, it's circular. So as the global economies do better, you know, our trade improves. Our companies are very global. The S&P 500 companies probably get almost half their sales now. That reinforces it all. So again, it doesn't translate into a crazy big number, but we think, you know, we're fairly confident that 2.3 is a number you can get and get with reasonable confidence around it.
So always in investing your money, it's relative to what? So I think the picture that has been drawn here is no real risk on the downside, hard to make a case for a big upside, but versus the choices, equities versus fixed income, still probably a better bet, and a little more weight internationally than domestically, emerging markets and developed.
Yeah, and look, and if rates, and it does look like rates are going to begin to go up, although look, the Fed looks at something called the Personal Consumption Expenditure Index. That's their measure. That's the measure of inflation they think is the most relevant. That's running right now at 1.6%. So even though the Fed's talking, you know, they're going to start to unwind their balance sheet, but slowly. You know, they're going to probably raise their Fed funds rates another 25 basis points at the end of this year, but we're still at, you know, 1%-ish. Let's remember that. We think that, you know, we think the Fed will err on letting things run hot for a while. They want to get that 2% inflation number because there's not a lot of distance between 1.6 and 0, right? And we all know they don't want to play with the deflation. So, you know, we think the Fed will begin the process, but if rates do go up, as we all know, that's not a good thing for bond prices. So the way to think about bonds is, A, they're a great diversifier in an asset allocation context, but what you pretty much get now going forward is, if you're lucky, the coupon. Before that, you got, you know, it was like a stock. You got capital gains plus a great coupon, you know, not a great coupon, but a good coupon, and your total return was nuts. So you're not going to get that anymore, but so you don't want to be, again, back to being underweight fixed income, but we'll see. But what's interesting, too, is you quoted the number. The Fed's got the biggest hedge fund, fixed income hedge fund globally is the Fed, the ECB, and the Japanese central bank. Together, they've got over $13 trillion of assets on their balance sheets. Think about that. And for the Fed, of the 2.8 trillion of the 4.5 trillion is U.S. Treasuries. They've been a natural buyer. And so even they have said, and these are their calculations, not ours, that by buying so aggressively, or by having so much on their balance sheet of Treasuries, they've kept the long-term bond down, by their calculation, by 92 basis points.
Almost a full percentage point.
And so, and by their calculation, if they just, and not aggressively, just let, as bonds mature, you just don't replace them, so the balance sheet goes down like this. Their calculation is that alone could add 15 basis points a year to Treasury, long-term Treasury yields.
Okay. Should we see what the audience here has on their mind? So we thought we'd open it up, and a hand went up really quick. Go ahead. We're going to try to have people use a mic so that everybody else, including us, can hear the question.
Thank you for your comments, Keith. I have a question for you. You know, you said that, you know, if you saw the situation changing where you would want to change your allocation out of stocks, you would make that change. I want to know, when has U.S. Trust actually ever done that? And then just one comment related. You know, I agreed with what you said about the market being overvalued, but it's actually more like 24 times unscrubbed earnings, and it's highest since its highest trailing PE basis since 1999. The consumer spending was down in Q1. We had below 1% growth. I don't see how you get to 2.3%. Anyway, a bunch of questions.
You'll see it in the second quarter. So, yeah, I'll forget half what you just asked me. So keep that, because I'm going to be asking you what you asked me. Let's go backwards. So, no, leave the microphone here, please, because I'm going to forget half this question. So let's go backwards. So the first quarter, there's something about the first quarter. So the first quarter is less than 1%. I think it got revised up to 1.2, still low. But the second quarter, I think, will be somewhere around at least 2.5%. Some are saying as high as 3%. So you got to kind of look at the first 2 quarters smooth, and it gives you probably a better sense. We're not running at a 3% rate. We weren't really running at a 1.2. You know, a big depressant in the first quarter was inventory drawdown. That's temporary. So if you take a 1.2 and a 2.5, there you go. You're out. You know, you're kind of around the run rate. You know, the PE multiple, the trailing is interesting, but the market's a forward. It's a discounting mechanism. It doesn't look backwards to determine what to pay for something. It looks forward. And so the thing that, you know, makes us feel a little bit better is the forward-looking PE multiple is 18.5. We've got, and don't forget, the PE is a numerator denominator, right? So as long as earnings are growing at a strong enough rate, and we saw, once again, 9% in the fourth quarter, 13% in the first, we think 9% in the second. If that can continue, you can grow your way to a point where you keep that PE looking more reasonable. And I think that's what the market's kind of focused on more now than, you know, because you're right, look backward looking, but we just came out of the best first quarter earnings season in 5 years. And for the first time in I don't know how many years, not only did earnings beat, but revenues beat. And that's been the missing element because, look, we do the same thing. You cut costs, you make your earnings number. And you can do that to some point, then you have no employees anymore. So, but I think we're starting to finally see, you know, a little bit of inflation, but some top-line revenue growth.
I think the other part of the question was when has a couple of times when U.S. Trust has actually changed its forecast.
So we were negative. If you look back when the market got crazily overvalued, you know, coming out of the multiple. Well, 2 times we got negative. When we were coming out of that technology bubble phase, we were negative.
Around 2000.
We were negative. I believe we went negative right, you know, around the time that we were going into I'm not saying as early as we could have, but we went negative as we were dipping over into the Great Recession period. And then we actually raised our ratings as we were coming out. I mean, to the credit of the team, you know, and it got me nervous because, you know, as things were looking really bleak, our economics team said they saw and they had a whole checklist of stuff that they said they gave them confidence that we were going to stabilize and begin to grow again. And that's when we went overweight equities, and it turned out to be the right call. So
I think we'll go on to another question, but what's interesting is that, and it's an obvious thing I'm about to say, is that everybody has their own opinion, every organization, everybody in the audience, and of course, that's what makes the markets interesting. And only after the fact do we know whether overvalued or it's not that high. It's high, okay, and so only after the fact we're going to know it. Somebody else? Okay. And then we'll get to you.
Good morning. Thank you. Thank you.
And if you could speak up, we'd appreciate it.
I'd like to focus our attention to some of the micro issue, and with our public debt exceeding our GDP significantly, and deficit continuing to be significant with last year's budget, over $600 billion or $4 trillion, and our war-related expenses continuing off balance sheets, and essentially every public pension fund being underfunded in the country and continue to get behind, given the growth. How can this whole affairs continue, expecting that actually, you know, our economy could grow, and even the public market? This public market is really surprising the way it's acting.
Yeah. No, look, it's a great point, and it's something that we spent a lot of time thinking about. So, I believe the numbers right now, you know, the public debt out there, you know, the debt held by the public from the, the government issued is $14 trillion, up from $4 trillion in 2006-07. So when the economy tipped over, right, government spending went crazy, and they had to borrow to do it because they had all the unemployment. They had the huge drop off in revenue because the economy decelerated. So you saw literally a surge from 4 trillion to 14 between, call it 2006 and today. 14 represents about 77% of GDP. So if you do a tour around the world, there are a lot of countries, this doesn't make it better, but just relatively speaking, there are a lot of countries that are well over 100% of GDP right now, 120, whatever. Now, here's what's even more worrisome, though, to your point, is that there's a view over the next, I think it's the next 10 years, we could see an additional $10 trillion of debt being added on, and I think that would take the ratio to GDP up to 89%. And then, interestingly, the other side of that equation, just to depress you more, is the net interest being paid, and and that's gone up commensurately with the rise. But I read something recently where they're saying that between now and 2027, net interest expense can go up by threefold. So it is an issue. One of the biggest challenges for the country are age demographics, right? I mean, we like the rest, like Europe, like Japan, you have the big baby boomer contingent that's aging, although interestingly, the much beloved millennials are now the biggest age cohort on the planet. So they're in the US, they're 75 million, so they've now surpassed the baby boomer. But we have a lot of people that are going to be continuing to move up, and that costs money, right? And so it's a structural problem that needs to be dealt with. It will not impact this cycle. It may not impact next cycle, but it's a factor that we watch very closely, and you got to see how all that backs up, because that could begin to back up on interest rates and and by the way, what the government really lucked out with is they incurred that increase in debt during a time of record low interest rates. Could you imagine if rates were at a more normal level? So it's a good point. It's an issue. We're watching it, but it's not going to have an immediate impact. But it's something we got to decide at what point does it begin to factor in.
I think that question, deserves a whole hour in itself, because it really is a structural issue. And there were a couple of other things we thought maybe we could discuss, but time pressure just doesn't allow it. And was a question, how about right over there?
Hi,
You're on.
this is a terrific session. Thank you.
Thank you.
Speak up, okay?
Can you hear me?
Yep.
Okay, great. Would you comment on your recommendations and opinion on equities in terms of ETFs versus index funds versus managed accounts, stock picking? Thank you.
Yep. Another great question. So, one of the things that's
another hour.
That's another hour, but I'll give it to you in 5 minutes or less. I'll give it to you in 3. How's that? So one of the things, if you look at, one of the things that's disappointed, when you look at active managers, is their returns have not been great, and it's a cyclical thing. Active managers will have good periods and bad periods, but net. And one of the things that one of the biggest detractors from the performance of active managers is the fee. It's high. And so if you're not generating a great gross return, by the time you net the fee out, you're left with not nearly enough. So what we try to do at U.S. Trust is, so let's say we have an equity allocation of X. Depending on what exposure we're trying to create, if it's a large cap exposure, and it's an S&P-like exposure, quite frankly, the best answer may be a S&P ETF, because you can get that at a very low price point. So what we're trying to do is get exposure at the lowest cost possible, but achieve the return outcome that we're shooting for. So you will find that in a lot of our portfolios, and increasingly so, it's a blend of active, passive, combination of ETF and index. And I think that's going to be, that's a trend that's going to continue. So what you want to do is really go active where you really think you can add a certain amount of alpha in a unique way that you can't get through a lower cost alternative. And in our view, the market share held by the ETFs and just the passive strategies, generally speaking, will continue to go up. It may slow down in years like this year, maybe next year when active strategies do better, but it's an inexorable trend, and ultimately, to be in true active strategy, you need to really be able to demonstrate you can add value consistently, not every year, but over a 5-year period. It better be at least 3 years.
Okay, we have time for one, maybe 2 more questions. You've had your hand up for a while.
One of the is the microphone working? There we go. One of the possible scenarios is that the investment bullishness, the animal spirits from businesses in the U.S. economy and perhaps outside the U.S. economy will continue for some time, accelerating the rate of growth. What do you see on that?
Yeah, so that's going to become, it's very important. And, irrespective of your view of the outcome of the election, the reality is both the consumer and business confidence went up dramatically. And that's what they call animal spirits. And so, and that's what's been missing from CEOs. They have not had the confidence or the optimism to really open the purse strings and invest. So if we continue to see animal spirits stay high, I'm especially focused on CEOs, and you get them starting to, and if that manifests itself in higher, and hopefully meaningfully higher CapEx, back to my point about the most direct link between higher productivity is more, that's a good thing. I think we're going to have to see for that to continue, and this is probably a 2018 impact, because this year, quite frankly, markets are being driven by fundamentals. The fundamentals are earnings, and fundamentals are low rates. And you have the prospect of maybe some fiscal help that won't come until 2018. To me, the most important things to happen to sustain the market, to sustain optimism, and to see more spending by consumers, but especially by businessmen and women, would be tax reform, would be regulatory reform, because that's been a big factor. And then I would love to see a way to find, I'd love to see the administration find a way to bring cash back as the repatriation. Because as I said before, if companies have roughly $2.5 trillion and half of that is overseas, if that money comes back to the U.S. and can then be invested, whether it's in jobs or capital investments, that would be huge. That could be the next leg. That could take you well to 2018 into 2019. And one of the things that's interesting, if you get that, here's what I tell you to watch out for. You could get almost, and this would spell the end of the cycle, mark my words, but you can get this melt up in PE multiples, because then people would get euphoric, finally, right? PE multiples arguably would expand, despite the fact they're lofty already, because think about where they went in the late 90s. So they could go maybe from 18.6 to in the low 20s. At the same time, you would get a continued surge in earnings. And that could be the blow-off. Because, look, what we got to remember is markets don't die of old age. Something has to kill them. And the something is usually the Fed. The only good thing about having a 2% growth rate over an 8-year period of time is the typical excesses that build up, mainly in the form of inflation, they're not there. They're nowhere to be found. And so that's what's allowed. So if you start to get that, the Fed will start to get more aggressive. That'll be the end. We'll do an RIP on this cycle, and then we'll wait for the next go round.
One quick question, and then.
Let me see if I can manage without the microphone. How do you pick between an ETF and an old, plain vanilla Vanguard index fund?
Well, it depends on the exposure you're trying to create. So a lot of the ETFs are more, they're either sector focused or more narrowly focused. The Vanguard index funds tend to be a broader exposure. So what we try to figure out is what are we trying to achieve in our allocation to equities? Where do we want exposures? Is it large cap equities? Is it small cap? Is it certain sectoral exposures? And then we go back and just say, with all of the passive alternatives out there, what is the most cost-efficient way to achieve that return, and then where do we need to satellite with more actively driven strategies that may be a higher price point, but bring something unique, and then the blend of all that, you know, gives you a blended fee, or blended cost rather, of delivery that is attractive.
Okay.
Okay, thank you.
Quick.
Keith, can you talk about the tax advantage strategies we have? A lot of people are focused on ETFs versus active in terms
Yep.
of cost, but there's also a tax component that's important.
Yeah, so one of the things that, you know, obviously we manage money for endowments and foundations too, so obviously nonprofits aren't as, after tax is not an issue. For our typical family and individual, after tax matters. So we have these tax-aware strategies that we use as an overlay, because this way they harvest losses and they make it all work. So they're not only delivering the highest return, they're delivering the highest after-tax return, which is critically important, and it's another element of what we put into the process of figuring out the optimal portfolio for clients that we take care of.
Okay, I think we're out of time. We'll let you go to your next session.
Yep.
I want to thank you all for getting up and coming this morning, and I want to thank Keith for doing this.
Appreciate it.